aside from something that's, effectively an act of God, or something that, I don't even want to mention what it could be, but something, some stupid dictator does something incredibly stupid. Outside of that, I just don't see that kind of, overall market risk. There's just, we're too big now. There's the immediate dissemination, the efficiency of,
Tomas, we are back, my friend. Even the S&Ps are down 6.5. NASDAQ down 78, but all that means nothing when you've got this man in the room, Chris Vecchio. Let me explain. Chris.
Gentlemen, good to see you again.
Good to see you.
See you healthy and vibrant and bouncing off walls, ready to go.
None of those things are true. Definitely not healthy, definitely not vibrant, though I'll tell you, a cup of coffee and a glass of emergency in the morning is a real kick in the pants. It really wakes you up.
Hi, Mr. Vecchio. We missed you. What do you got going on?
Well, I figure we have two things to discuss this morning. First off, earnings season, and then let's talk about this Fed meeting that's coming up tomorrow. I know it's one of your favorite market holidays of the year, 8 times a year, but earnings actually haven't been that bad. We went through a little stretch where they weren't great, but things have turned the corner. Through the end of last week, the blended earnings growth rate year over year is now 2.7%. It's going to be the first time since the third quarter of 2022 that we've actually seen positive earnings growth across the S&P 500. We've also seen that earnings have gone up while the equity index prices have come in, and that's actually helped reduce some of the overvaluation in the market. The PE ratio at the end of last week for the S&P 500 was 17.1. That's below the 5-year average of 18.7, below the 10-year average of 17.5. So some of that froth is coming out of this marketplace. But markets, generally speaking, really haven't been sitting on, great footing, as it were, at least directionally, so to speak. Breadth in the market has been terrible. Less than 50% of stocks in the NASDAQ are trading above their 200-day moving average. Less than 30% of stocks in the S&P 500 are trading above their 200-day moving average. The month of October, for all of the prognostications, including from yours truly here, about it being a potential bear killer, were obviously wrong. It's ahistoric to see October produce such poor results. And as we wind down this month, it looks like it's going to be a bad one all in all. But it was only a bad one if you were a directional trader. This was a good month if you were someone who was looking to capitalize on the volatility environment. And so I guess my question to you guys today is, was October bad for you as it was for the market, or was this uptick in volatility actually a welcome development because it meant more trading opportunities?
There's definitely been more trading. Our volumes are up a lot. Our personal volumes are up a lot.
Our capital usage is up.
Capital usage, positions, volume, positions, everything. This is kind of a tasty dream,
Sure.
And I wrote about it over the weekend because I think it's a very important distinction. I'm glad you brought this up. I've never been somebody that believes the market doesn't care about earnings at all. Earnings are priced into the market long before these companies even know what their earnings are. Like before they all sit around and say, hey, this is what our accountants came up with. This is what the number we're going to report. What do you think? Is it good or bad? Everything's already into the market long before that, just based on, all other factors and everything that goes into computing that. So as an efficient market theorist, if you're going to have good earnings, there's a very good chance, there's an equal chance that the market will be up or down, whether the industry has good earnings or not. And that's exactly what's happening now. The market's going lower, but earnings were generally good across the board. There were, outside of today, which is the Caterpillar surprise to the downside, I'm trying to remember, Pat, was there an ugly downside move in any major earnings? I know Meta was down, but it wasn't outside the expected move.
No, nothing crazy.
I don't think there was a big name.
Alphabet had a bad reaction to its earnings. Google.
Oh, yeah, it did, but it was only down $12 total. It was just outside the expected move by like $3 or $4. I don't know, whatever. You're right, but it wasn't. I think in general,
there was no like huge 2-3 standard deviation outlier move.
Right. We live about around 2 times the expected move for most earnings trades around that area. Mm-hmm. And if you live around 2 times the expected move, you did not take much heat this whole cycle. And I think it was a pretty good earnings cycle, but I think the market, the market's heavy for a lot of other reasons. And I just don't think you can look at the earnings cycle and tie that back to the stock market. I think that's already really priced in, long in advance. I think that the cool thing about earnings is where you were going before, which is earnings are just a binary opportunity that allows us to participate every single day in things that we normally wouldn't do. So like you can change your durations, you can participate in things, and therefore earnings are like today, a lot of people will trade AMD that normally wouldn't trade AMD. That's it. It's just a binary thing. So I think that for that reason, that's the cool part about earnings.
It felt like that we've seen a big uptick in vol, but Anton pointed out to me recently, in fact, on yesterday's Futures Power Hour, that even though the market's been declining, volatility hasn't been screaming higher. It's been kind of, if you look at the cash VIX,
not at all,
bobbing around around 20. He was seeing this as an indication that this is perhaps a sign that this decline has been a little bit more orderly, and we should make hay while the sun shines, taking advantage of this decline in the market and the expansion of vol to potentially be looking at selling some puts down here in the S&P 500. Now, I don't know about you guys. I've traded basically three things this entire month: S&P, NASDAQ, and gold. My S&P position, which I put on October 6th, it ended up getting knocked out at break even. The NASDAQ, I took a small loss on. Gold has done quite well. I got in at 1844 on NFP Friday, and I'm still holding it long contract outright. And that's going to paper over my losses elsewhere. But I am drawn like a moth to the flame, this idea that maybe we're coming into some sort of technical support here. And when you see a 53 or 52 IVR in the S&P, and knowing that volatility typically does not stay elevated for a very long period of time, it does seem tempting to take a shot here, perhaps even on a short-term basis, not necessarily 45 days, but maybe even something a little bit closer in, 3 or 4 DTE, saying that we could be looking at potential near-term lows. And the Fed meeting this week, that's certainly a potent catalyst to produce a strong reaction in stocks in the very short term. But I'm going to say something that I think you guys will appreciate. I don't think tomorrow's Fed meeting matters at all whatsoever. You take a look at the pricing in the futures or the SR3 contracts, these 60 rates, and there's less than a 5% chance that the Fed does anything one way or the other tomorrow. It's bounced back and forth, in fact, between a rate cut and a small rate hike odds. And I think the important thing here for people to understand is a reference, or at least a stat that I've referenced previously, going back to 1996, unless the pricing is at 55% for a rate hike or a rate cut, the Fed does not move. Period. End of story. Anytime you've seen the odds exceed 55% in either direction, the Fed's gone in that direction 100% of the time. And so when you look at a 2.7% chance of a cut or a 1.4% chance of a hike, the market is not expecting anything whatsoever. And to that end, the market's not expecting any more hikes this cycle from the Fed. Rate odds are rare to exceed 30, 35% if you look at the December or January meetings. And by the time you roll out to June, you have a rate cut fully priced in by the market, at least 63% chance, according to the CME FedWatch tool here today. So tomorrow's Fed meeting, a lot of sound, a lot of fury. We're going to have that policy statement. We're going to have that press conference from Jerome Powell 30 minutes later. But in terms of a big market move, this Fed meeting may come and go. And if you take a nap from 2 to 3 p.m. Eastern tomorrow, you probably won't know that you missed anything whatsoever.
I'm not going to argue with any of that. We actually had a discussion this morning on Confirm and Send, and one of the questions that came in is, given what's happened lately, don't you think volatility is cheap here? And the answer we gave them was no, because again, getting back to the efficient market theory, volatility contracts or stays in a lull state. We talked about this 90% of the time. It only expands 10% of the time. So you can never really trade it, assuming that you're going to get some kind of vol expansion. And you're right, volatility does contract pretty fast when it contracts. I think that we're in a different world now, and although things, as much as we like to think things always stay the same and nothing really ever changes, there is so much capital and so much efficiency in markets today that I feel like a lot of the volatility risk that we used to live with because of thin markets and inefficient markets and things like that just don't exist in 2023. And it would be very difficult, to have a replay of some of those, crazy vol moves when, going back, Tony and I both traded in 1987, and I feel like I feel like $100 million, almost crashed the market. And then going back to long-term capital markets, the whole meltdown of long-term capital, in 1998, I think it was, that was like $2 billion or $2.5 billion. Now, $2 billion is a 25-cent downtick in Apple, and so, you almost need $1 trillion to move the markets. And I just don't see, aside from something that's, effectively an act of God, or something that, I don't even want to mention what it could be, but something, some stupid dictator does something incredibly stupid. Outside of that, I just don't see that kind of, overall market risk. There's just, we're too big now. There's the immediate dissemination, the efficiency of, a lot of what caused the crash in '87 and then the mini crash after that in '89 and the meltdown in 2001, 2002. I think was the fact that high frequency was in its infancy, and we were relying on exchanges. So there's no way that Tom Sosnoff and Tony Batista were going to step in the middle of a market crashing. Okay, we're going to put our hands in our pockets and walk away. But in 2023, the world's a different place now, and the exchanges are now just facilitating machines. So
there's always that move that nobody sees. That
I understand, and I agree with you, and that is possible. But in the world we live in today, the exchanges are out of the equation. So we no longer rely on the exchanges to make markets, and so all the market making is done off floor. And with that, for the last 20 years, that movement towards high frequency market making has completely changed the risk game. Individual underlyings can have a ton of risk, but the overall market, I don't even remember the last time we had a circuit breaker.
Yeah, it's been a while. Yeah, I would give you.
Maybe the 2010 flash crash.
No. We had circuit breakers in 2020.
During the pandemic, yeah.
During the pandemic, there were downside circuit breakers and upside circuit breakers. There weren't market circuit breakers in the meme stock stuff, but there were individual stock circuit breakers. But it's a different world right now, and that's why vol is so muted. The market understands volatility much better in 2023 than it understood volatility in 1987 and 1999 and 2008 and everything like that. And there's also technology has improved so much that everybody manages risk differently today than they did whenever. So I just we all sit here and we go, volatility is way too cheap and this blah blah blah, but I'm not sure. I'm not sure if it really is. I think it's priced perfectly.
Well, for people that are interested in the 1987 crash, I suppose I'll give the shameless plug. You guys did a very interesting documentary called Cancel Crash a while back for tastylive. You can simply Google Cancel Crash tastylive and find out the information.
You can link to it on the tastylive website, or you can Google it. It's 35. It's about 40 minutes. We did it in 2012. That documentary, or I'm sorry. We did it at 2013, 2012. It was the 25-year anniversary.
It's definitely worth a listen. Hearing you guys talk about how you're sitting around, the tables in Vegas, being like, "We got to get back. We got to fly back to Chicago. We can't not be there Monday morning."
That was Tom. Tom was on vacation again. I was working. I was in the pit.
It was Jules and I, and we were in Vegas. I forgot who else was with us, but yeah, we made that call that weekend. But I was in the pit Friday for expiration, and then the following Monday, and I stayed till the close. So I remember it like it was yesterday. I really do remember it like it was yesterday. It's scary. And that was, now we're talking, 35 years ago. Mm-hmm. So it's kind of crazy.
Tom, you brought up meme stocks here, and there's been this interesting thing going around X, Twitter in recent days, because someone was complaining that their BBBY shares were taken out of their trading account. The company Bed Bath & Beyond, of course, was delisted. Bed Bath & Beyond was one of those meme stock darlings for a small period of time because they declared bankruptcy, and then the stock started shooting up a little bit, reminiscent of what we saw with Hertz during the pandemic. But people seem to think that just because you own a company that, it's always going to retain value. I think it's important for people to understand that if you're trading in illiquid assets, companies that have just gone belly up and bankrupt and you're looking to make a quick buck on it, if the shares are delisted, you may still own 100 shares, you may still own 1 million shares. 1 million times $0 is still $0. They're just worthless pieces of paper. And I think that goes to show that if you're going to be trading, or at least if you're going to be operating, I think is the more appropriate term, if you're going to be operating in some of these high risk, high volatility stocks, doing it on an active basis where you're jumping in and out of the market, where you're taking small positions and moving in and out on a day-to-day basis or week-to-week basis, as opposed to just accumulating shares and hoping for that GME or AMC type of move where you get that big, gamma unwind, this big tail wagging the dog situation in the options market. It's better suited. It's important for traders to understand that just because you buy something doesn't mean it has any value, particularly if you can't sell it, which is why we focus so much on liquidity on the platform. There's those little stars that you see in the right-hand panel that tell you the liquidity conditions.
Yeah, we actually don't even support NASDAQ bulletin board stocks. We don't support OTC BB stocks on Tasty for fraud reasons.
Exactly.
So we don't even let you hold them. We don't even, there probably is a BBBY pink sheet market. I don't really know, actually. I thought somebody bought the name. I'm not really sure, but we don't even support that for fraud reasons, because 90% in the financial world, there's a lot of scammers, and 90% of our fraud scam losses had to do with penny stocks. People would wormhole into computers at other brokerage firms, and then they would try to steal money back and forth. It's horrible. So we stopped offering, other firms stopped offering penny stocks too. Some firms still do. And that eliminated 90% of the fraud.
But just like Tom was talking about the crash scenario, the way things happened in the past, how much that has changed just because of the size of the market, that meme stock phenomenon, I think that's done too. I don't think that ever happens again to that magnitude. Sure, you can have stocks that gap up or gap down on whatever reason, whether it be news or anything other related, sector rotation.
Really, Tony? I don't know if I agree with you.
I don't think so, man. I don't think so.
I'm with Tony here. I mean, I think that was really circumstantial based on what was happening, right? Speculation is part of the human impulse. We love to gamble on things. We love to bet on things. We love to try to predict the future. And what happened during the meme stock era? Sports leagues were closed. Sports leagues were closed because, the world was shut down effectively. And so you have this whole group of speculators out there who need to scratch this itch. But what is still open? You can't go and bet on NBA games or baseball games or football games, but financial markets are there. And so you have all these individuals who are coming back into the market for the first time. They're trying to scratch that itch. I think without another situation where you see, global betting leagues effectively shuttered, you're not going to see that type of participation in retail markets again for a very long time.
I agree with you that it was a transformational moment with respect to the size of the new audience. It's something that I didn't think, I visualized it. I was hoping we'd see it for other reasons, but I never could actually figure out how or why. I think it caught everybody by surprise, and obviously, Robinhood more than most, but they were the beneficiary of it too. I do think that, as long as I've been trading, there have been crazy situations like that. I don't think any of that will ever go away.
Yeah, but I don't think the meme stock phenomenon will come.
I don't think you're going to see a GameStop go from $20 to $500. But I will say that you touched on something else, Chris, that's important. There is a hidden underbelly of speculation, of capital set aside for speculation, that has been grossly underestimated by every financial service firm in the world. Like, people say to us all the time, they go, why don't you do managed money, or why don't you do, I'm like, we don't want it. That's not our thing. We don't do that. But what we believe is that there's this unhidden, unlocked, hundreds of billions of dollars of speculative capital that lives around the world, where people, if they knew they had access to efficient liquid markets, strategic, efficient liquid markets, they would participate. And that's what we're betting on.
I think it's a good bet. It's part of the human condition. We like to try to predict the future, and that itch always needs to be scratched some way, somehow.
Yeah, and the thing that the meme stock did, the meme stock opened up that kind of that visual to everybody. That's why it was transformational, because there was an entire generation that was just dying to do something, and they finally did it. And I think that, that was the tip of the iceberg. And I think that's lurking out there, this massive audience. So you saw the same thing in China, but their markets weren't efficient. We happen to have efficient markets. I mean, listen, the fact that it happened in GameStop was sad, because that's that's not sustainable, and you don't want AMC and GameStop to be your first introduction into the world of finance. But the fact that wave exists, and I think it's critically important, and I think that it's a message that we're just scratching the surface for what you're going to be able to do, over the next, like when you see the stuff we're building now for an exchange. It's revolutionary. And I think you're going to see a combination of modern decentralized technology meets listed marketplaces. And I think in the future, Chris Vecchio, instead of having 10 choices, is going to have 100 choices, all with one tick wide markets.
And that's good for everyone at the end of the day.
I totally agree.
Beautiful. All right. Good discussion. We're ready to take a quick
Mr. Vecchio, good chat.
Good job out of you. Let's hit a quick 90-second break and come back. We got more Tasty Live after this with a market measure. Thank you, Chris.
Gentlemen.
Thank you, sir.